Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. This is Christopher Cahill, your host. Later on, I will speak with Jim Dowd, founder and managing director of North Capital Companies. He is going to explain how the balance has shifted from funds to investors. But first, I'd like to direct your attention. In this post-Jobs Act era, when accredited investors have more access than they had before to alternative assets, I'd like to direct your attention to a series of webinars here on, they're on Financial Poise Webinars, which is a sister site to Accredited Investor Markets. All of this is, by the way, accessible through www.financialpoise.com. Anyway, the webinar website has a 9-part series called Alternative Investment Basic Series 2015. And they're coming out every month on an ongoing basis. More on those webinars in a moment. But first, with the Jobs Act opening up new legitimate opportunities for accredited investors, it also opened up new opportunities for fraudsters, those who would seek opportunities to defraud others. Now, a premise of the Jobs Act opening was that accredited investors have sufficient sophistication to take care of themselves. However, fraud is alive and well, and the buyer must beware, which is more or less the title of an article by Jonathan Friedland, the publisher of Accredited Investor Markets. This article was posted 5/22/2015 on AccreditedInvestorMarkets.com. Its official title is Fraud is Alive and Well, Buyer Beware. Now, one of the virtues of the article by Mr. Friedland is that it links to other important and helpful articles. This is a common feature of articles on Accredited Investor Markets, by the way. Mr. Friedland's article links to a piece entitled Watch Out for Investment Scams by Stephen A. Bornstein, who is a lawyer to Wall Street firms. The Bornstein article links to websites on which federal and state insurance regulators keep tabs on licensed practitioners. The websites include websites devoted to stockbrokers, SEC-registered investment advisors, state-registered investment advisors, financial planners, and insurance agents. So, you have the opportunity, by looking at Friedland's article, Bornstein's article, and the other things linked to it, to vindicate a premise of the Jobs Act, and that premise being that accredited investors can protect themselves by looking before they leap. Now, in the Friedland article, there's discussion of Mr. Mark Malik. He's a New York scam artist we talked about before on this program. He was the one who stole more than $700,000 from investors, posing as a fund manager. And as we discussed on the earlier program, he really thought that he was just saving money to get married. Anyway, while Mr. Malik was active and before this was exposed, Bloomberg LP called him, quote, a rising fund manager, end quote. Barclay Hedge Limited reported that Malik's funds generated returns of 288% in 2010 and 189% in 2012. In addition to looking before you leap, you might consider that if something sounds too good to be true, it is. But nevertheless, Barclay Hedge reported that. Infovest 21, which is all one word, Infovest and then the number 21, said nice things too about Mr. Malik's funds. In fact, at the end of 2012, the fund's brokerage account held but $269.52. What's the point? Bloomberg is simply journalists, and the other two entities, Hedge and Infovest 21, tell you that the information they have is provided by fund managers, i.e. Mr. Malik, and is not independently verified. So it stands to reason that Friedland repeats in his article, you should not trust ratings. Perhaps some of you are too young to remember President Reagan negotiating with the USSR And as regards such negotiations, President Reagan said memorably, trust but verify. And those should be watchwords for looking at investment-related thoughts, advice, good words, recommendations, anything you see in print. And to help you learn more about fraud, Mr. Friedland's article does more. It links to a page of 12 more articles available on accreditedinvestormarkets.com. Those articles include, I'll just read some titles. FINRA addresses compliance issues in annual letter. The SEC and FINRA got your back. Know your online securities intermediary or lack thereof. That's written by Andrew Stevenson of CrowdCheck, a prominent investment platform. Looking for a financial advisor? Here's what not to do. Investor fraud protection. Who's got your back? 5 things you should ask your financial advisor. Okay, that's a number of them. Included also is a link to the FINRA, Financial Industry Regulatory Authority website and articles thereon. Finally, to get back to that webinar series, Alternative Investment Basic Series 2015, I'll say, because I'm involved in them myself, that fraud and where it might appear and how it might be guarded against is a perennial subtopic within those discussions. Again, look at Financial Poise webinars on the financialpoise.com website. And now, on to our interview. Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill of Accredited Investor Markets, and today we are speaking with Jim Dowd, and we're going to be talking about private placement platforms. Jim is the founder and managing director of the North Capital companies, which include a registered investment advisor, a registered broker-dealer, and a financial technology company that serves financial institutions and other companies involved in conducting private offerings. Jim Dowd is a 30-year veteran of global financial markets. Welcome to the show, Jim.
Thanks, Chris.
So first, North Capital has been around a while, and as I understand it, and please correct me if I'm wrong, North Capital units have marketed technology solutions to facilitate regulatory compliance for private placement platforms. And just pausing there, regulatory compliance involves at least making sure that accredited investors are accredited investors before they buy something, as well as things like preventing money laundering and so on from taking place through the platform. But now North Capital has established its own platform called 99 Funding, and that platform is described as, quote, broker-vetted, syndicated private offerings, end quote. Jim, do I have it right?
That's right. So we really have 3 parts to our business, and you accurately described one of them, which is what we refer to as the technology licensing side. And what we've really done is taken the technology that we developed for our own use as a broker-dealer and in the placement business, and created a technology business around it for other broker-dealers, for other funding platforms, and really for anybody that's trying to conduct a private offering using general solicitation. And so within that licensing that technology business, we're really focused on delivering all the things that you described, the kind of know your customer, the anti-money laundering and OFAC check pre-clearance for prospective investors, as well as the investor verification, payments, and processing.
Well, great. But let's, since we're going to be talking about funding platforms, let's talk a little bit more about yours. It's described as, quote, broker-vetted, syndicated private offerings are what you get on this platform. What does it mean, syndicated? What does it mean, broker-vetted?
So broker vetted, let's start with that. I mean, what that means is that all of the offerings that are available through the 99 Funding platform, and really all the offerings that we're involved with as a broker-dealer, go through a review and due diligence process. That's one of our requirements as a regulated entity, is that any offering that we are involved with as the lead underwriter, as the lead placement agent, is subject to a review process that we go through to ensure that not only the statutory requirements are met, that there are no bad actors, that the companies are appropriately incorporated and established, but also that the investment opportunity is consistent with what we want to show to investors. So it's sort of a two-pronged diligence process. It's an operational aspect, which is kind of the dotting the I's and crossing the T's, and then an investment diligence aspect, which is making sure that the investment is something that's appropriate for the investors that we bring to the platform. So that's the broker vetted piece. The syndicated piece means that we're working with other broker-dealers and with other funding platforms, primarily our partners, and we have a number of partner funding platforms to help raise money for deals that are originated on their platforms. So that primarily occurs in the early stage space, so very early stage technology deals and other kind of early stage investment opportunities that may be originated from a number of different sources.
So as far as broker vetting, have you found some deals that came up short?
Absolutely. I mean, ironically, or maybe not ironically, but not surprisingly, most of the deals come up short. I mean, we probably ultimately end up involved with between 1% and 3% of the deals that come across the transom in terms of people who are looking for opportunities. And what's not surprising is that the number of deals that come through versus the number of opportunities that are really ready for outside investment is it's a very high ratio. So in other words, we see a lot of people who are seeking capital who really haven't done the work and aren't in a position yet to be able to sort of support bringing in third-party investment capital. And so that's part of what our job is to make sure that before a company does go out and try to raise money, that they've got their business in order where they can not only utilize the capital but also make sure that the investors are protected and are getting the investment that they're promised, and that all the documents are in order and that kind of thing.
Well, just to explore the broker vetting just a little bit more, what sorts of things does a company lack? Does it lack appropriate financial and capital controls? Is its capital structure wrong? Is it simply lack enough sales or marketing function? What kinds of things does it lack?
That's a great question. I mean, I would say that the types of problems that we identify really kind of break down into three different categories. One is where it's just early in the process, and maybe the company hasn't done the work that's required to support a successful offering, and that may just be a question of time and money and sort of knowledge to figure out how to structure the offering in a way that is going to appeal to investors and satisfy the obligations that they have once they bring in outside money. So that's kind of the easiest one to cure, because in a lot of cases it's just a question of the opportunity, the business getting a little bit more experience, a little bit more traction, a little bit more proof of concept, and and then putting in the time and money to be able to do the offering. The other two ways where offerings come up short, one is where basically it's just not an investment that we decide or we think in our view is something that makes sense for investors. And that really has to do more with what the market opportunity looks like, or it could be how the company is positioning itself in terms of their product or their service that they're providing. But basically it's a problem with the investment or a problem with the company that is investment related, opportunity related. And that's really not curable, because because you can have a great idea that is not a great investment, and you can have a great market opportunity but not a great company or not a great solution. So those types of situations, obviously are kind of impossible to cure, but they may be good businesses but not great investment opportunities. And then the third category is where there's some sort of a diligence issue, a red flag, as we like to call them, that causes us to not want to move forward. And that could be anything from the principal of the business exaggerating their academic credentials or their professional credentials. It could be that financial statements are exaggerated or in some cases made up. It could be that the overall presentation is exaggerated and doesn't sort of offer a fair presentation of the risks. So anything that's kind of in that category that causes us to lose confidence in the management team or in the any of the materials that they're presenting, that also becomes kind of a deal killer for us.
Okay, can you tell me why did you choose the name 99 Funding?
Yeah, so we chose the name actually a couple of years ago, and it was at the time when the Jobs Act, which passed in 2012, was just kind of in the process of going through its final legislative process. And I don't know if you recall, but that was at the time when when sort of the Occupy Wall Street movement was going on, and there was a tremendous amount of kind of distrust and dissatisfaction with the fact that ordinary people were being treated one way, and there was this perception that Wall Street and the investment community had kind of a sort of a different set of issues and were treated differently, and we thought that it was a little bit of a play on words, but we thought at the time that it was kind of apropos of what was happening in the venture market. Here you had venture capitalists in Silicon Valley who were literally making millions of dollars on companies like Uber and Box and a variety of startup companies, and ordinary investors were basically shut out at the door and told you're not allowed to participate. And so we thought with the Jobs Act, here's an opportunity finally where ordinary investors can finally invest in early stage companies, not with large amounts of their net worth and large amounts of assets, but they can dabble if they want to. And our view has always been that if investors want to take a portion of their portfolio and allocate a small portion of it to high-risk investments that potentially are high return, then they should be allowed to do that. And that's kind of the promise of the Jobs Act, and what we hope will eventually become the reality.
Well, as we all know, the reality is that private placement platforms are virtually restricted almost entirely to accredited investors or family offices or extremely high net worth individuals. But would it be fair to say that the name of this platform portends your desire or your ability to open it up to non-accredited investors should the legal and financial environment give that opportunity?
Yes, without a doubt. I mean, we see the opportunity down the road as one where anyone should be able to invest again a portion of their investment capital in startup ventures and in private ventures, and so we see a day hopefully in the not too distant future where we'll have deals that are available for accredited investors. We'll have Reg A Plus deals that are essentially available to everyone, and we'll have so-called Title III deals that are available as well to non-accredited investors with in certain smaller offering amounts. And we see one of the reasons why when the Jobs Act originally passed and the regulations, draft regulations started to come down, and it became apparent that the SEC was going to charge FINRA with the regulation of this new marketplace that was emerging. We really embraced that, and we had already gone down the road of setting up a broker-dealer, and we took that opportunity to really kind of embrace the idea of investor protection, embrace the idea of regulation. But the idea has always been that once the market opens up for regular investors, so to speak, so below accredited investor, that we want to be there and able to address that market.
All right, well, let's talk about funding platforms in general then. How do you answer the following question? How have funding platforms affected the private fund market?
I think they've affected it for the better in a couple of ways. One is that there's been an explosion of technological innovation addressing the private market, and the fact that there has been a proliferation of funding platforms since the passage of the Jobs Act has really led to technology innovation that has gone much broader than than sort of the publicly facing funding platforms that are kind of well known and well publicized. So I think that's one aspect where the technology is making it easier, faster, less expensive, and more controlled to invest in private offerings. And just to give you a couple of examples of that, 5 years ago, nobody would have thought possible someone could electronically verify someone's accredited status kind of in real time through a funding platform, and that's happening routinely across a number of platforms that are available today. Similarly, payments were traditionally kind of part of a fairly arcane subscription and trading process where people would print out 100 pages of subscription documents, spend an hour and a half, 2 hours waiting through the forms trying to figure out where to sign them, fax them back, then orchestrate a separate wire transfer or send in a check to an administrator to be able to arrange for payment. And that's been compressed now to where that entire process takes place online. It's very streamlined. The documents can be e-signed and distributed to everybody that needs to receive them, and then the money transfers can take place via ACH. And so those are developments that basically are completely the result of funding platforms and the progress that's been made in the last few years. I would say the second area that's been a huge benefit for investors as well as for issuers is that the access to deals has expanded dramatically. And this is something that is a direct result of the changes in Regulation D under the Securities Act because of the general solicitation provisions, so the so-called 506C offerings. Because there's an ability now to disseminate information widely, investors get access to deals that they might not have been able to see previously, and issuers can essentially go out and promote their offerings widely to a broad set of investors without knowing who's accredited and who's not, because that's not something that's necessarily apparent to somebody unless you have a pre-existing relationship, which of course is what the prior rule was in any event.
Does that mean more money is going into private placements?
I think that's indisputable. I mean, the statistics over the last few years indicate that in some segments that the private markets are as important, if not more important, than public markets. So I think don't think there's any doubt that there's a lot more capital flowing into private offerings now.
Does the availability of private placement platforms that a accredited investor or others who qualify can look at help those investors evaluate pricing of a given deal?
I don't know that it helps investors evaluate pricing of a given deal, but it definitely helps them evaluate deals relative to each other, and that's something that previously was difficult or impossible to achieve. So because prior to general solicitation, the only way that investors would even be aware of a private offering occurring is if they had a brokerage relationship with an advisor, with a broker who kind of specialize in those types of offerings, and a lot of firms don't get involved in those types of offerings, or if they had personal connections with people who were involved in private offerings. Now you have those sources, but in addition you've got a series of funding platforms that are basically in business to try to disseminate information about private offerings. So if one goes to Seed Invest or OneVest, who are two of our partners, or Mass Catalyst or AngelList, and kind of compares the different deals that are available, you can see what the different valuations are for companies that are addressing similar opportunities with similar technology. You can kind of get an idea in general of what early stage companies are pricing out at, and it becomes a way of kind of gauging the relative valuation of opportunities in the early stage space specifically.
So Jim, it seems, if I may draw a picture, that the Rodney Dangerfield character in Caddyshack now has similar access that he would not have had before to private deals, whereas the Ted Knight character would have had all the access before, but now he's sharing the same body of information perhaps with Rodney Dangerfield. Do you think that's fair?
Well, I think there's no question that from an investor standpoint, investors have more access to information than they did before, and to some extent, issuers, or the people who are trying to raise capital, are more willing to provide information than they were before because it's giving them access to wider and deeper pools of capital. So as with any market, if you have more transparency and you have more participants, then there's going to be better liquidity, and I think that's what we're seeing in private markets.
Well, all right. Have funding platforms taken business away from private funds that are not sold through funding platforms?
I don't think that they've taken business away. I think that the market has expanded at a pace that has been greater than sort of the growth of any one segment. So rather than seeing kind of a static market where opportunities are shifting from the funds to the individual investors, I think what's happening is that the overall market is growing, and the funds are choosing to participate in deals that are a little bit more advanced, further along, and where frankly more capital is required, because for fund investors, as they've been the beneficiaries of larger inflows and larger investments from LPs, the average amount that they need to put to work in deals has gone up as well. So I think that a lot of the early stage deals, that sort of kind of investment is moved away from the funds, or tended to move away from the funds and towards individual investors, angel groups, and that. But I wouldn't say that it's a situation of the funding platforms displacing the funds. I think that was in motion before funding platforms started to become, a factor.
Well, all right. Let's close by looking toward the future. What kinds of changes do you forecast, either in the sorts of entities that participate in private placements, or in the greater practical availability of platforms to non-accredited investors?
So let me address the first question initially, and that's that I think the trends that we've seen over the past few years with greater technology or application of technology to the market leading to more liquidity and more transparency, that's all going to continue. And I think it's going to expand in ways that, we wouldn't have anticipated a few years ago. So in addition to early stage platforms and real estate, which are kind of the two main areas where funding platforms have really taken off, I think we'll start to see more funding platforms focused in other private markets as well, in segments like energy partnerships and private funds, private equity, early stage private funds, and hedge funds. So I think you'll start to see more funding platforms in kind of those spaces, and that some of the technology that's been developed will be applied there as well. And I think you'll see a trend towards building more of a traditional financial network for those products as well. So currently the market is very much of a kind of relationship between issuer and investor, and the brokers have really not tended to be deeply involved. The brokerage community has not tended to be deeply involved in private offerings in terms of kind of the transaction settlement and ongoing management. And I think that's going to change. I think you'll see the product become more mainstream and begin to work more like traditional stock transactions, for example. And then I think to your second issue about sort of the kind of the access for non-accredited investors, I think that remains to be seen. I mean, to a degree, it will depend on what the regulations look like when they're finally promulgated, and whether or not they create new barriers that maybe we can't foresee today what those might be. But I do believe that there's a considerable pressure from investors primarily to be able to access these deals. And part of the reason why we created 99 Funding, the idea that investment opportunity should be available to everyone, provided that they understand the risk, and the risk is monitored and sort of and taken at appropriate levels, that idea is intrinsic in the Jobs Act, and and will eventually kind of filter through the market.
Well, Jim Dowd, founder and managing director of the North Capital Companies, I thank you for your learned perspective.
Thank you very much, Chris. I appreciate your time.
And thank you all for listening to Accredited Investor Markets Radio, which is produced by Stephanie Strait. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.